have retail investors and what is traditionally known as the dumb money finally beaten the sharks, aka the hedge funds, the large institutional investors? Has the casino finally lost the game? Well, we're going to try and find that out in this episode. And if you're new to the channel, welcome. My name is Sang. I used to work at some of the largest hedge funds in the world, including Bridgewater under Ray Dalio and some of the largest sovereign hedge funds in the world as well, here in Singapore under GIC and Temasek, and a whole bunch of other institutional investment companies. But here I am because I've kind of exited from the system and the game and doing this on my own and sharing what I've learned over the past couple of decades to people like you who have tuned in. So before we get there, I just want to give a shout out, number one, to all the people who commented in my last episode, which is about how I liquidated all my physical gold. And I'm just really happy that I even get a lot of comments. That means there's more people watching and learning and, with the information that I'm sharing. But there was a lot of backlash and angry people in the last episode's comment section. And if you look over here, you'll see people saying stuff like, you're a moron. I mean, these are some pretty good stuff, right? Like, I never owned gold. I was only trading fake paper gold, and I'm young. Thank you to think that I'm young. I'm not young, unless you think being 50 is young. Yeah, I mean, I'm an amateur. I live in my mom's basement. Liquidated 3 ounces, stupid. I mean, some of this stuff is great. But I just wanted to, just say that, look, it's actually not about the gold, right? And no, I don't live in my mom's basement. This is not my mom. I wish I actually were in my mom's basement because she's getting older and I want to spend more time with her, but she's over in Korea while I'm here in Singapore. But in any event, I'm not dealing with a few ounces. I mean, it's, I'm dealing with kilograms of gold, and people who are in the Discord already know about this. But it's not about the asset, actually. It's about managing risk and managing a portfolio that matters. And gold just happens to be the asset class that I liquidated. And if you look at why, I mean, look, this is a long-term chart of gold going back to 1976, all right? So where we are is over here. And if you look at where we are, this is the RSI on the monthly time frame. We are at 85, okay? This is really high on the RSI monthly time frame. And if you look back all the way back into 1975, which is, a good 50 years ago, we've only gotten this high in the monthly RSI a handful of other times, 1, 2, 3, 4. This one was in the 1980 spike where it intraday hit $1,000, then just, kind of collapsed after that. The last couple of times after that, we've had some pretty serious corrections, right? And the most recent one in the end of 1920, we had a pretty good, 2020 rather, we had a pretty good correction over here. And here we are again, we had a double touch. So any technical trader will tell you that when the RSI, in the monthly time frame is this high and you're approaching pretty much some pretty, important resistance point, it's a good idea to cash out, realize your gains, especially if you've doubled your gains. It's a good idea to, at this point, there's not too much room for it to go much higher. And so it's a good idea to kind of cash out, realize your gains, and lock in, whatever profits you have. And if this thing continues to go up, well, I'm more than happy to, like I've been saying, I'm a long-term gold, bull for the obvious reasons of, the debt fiasco that we're in. And so I'm definitely a long bull. I'm more than happy to go back in if we continue to go up. It's just, chances are there's not much more room up here. And it's a good thing till, if it just meanders around here and goes down a little bit, great. I want to get more gold at a cheaper price so that when it does go up, I'll have even more gold. That's the whole plan here, right? It's not like, there was one comment that was saying, like, I'm part of the cabal that's like, I'm getting paid to suppress the price of gold. And I'm like, dude, I am such small fish. And not many people watch my channel anyway. So the few who do, I mean, great for you. But, it's just interesting to see the amount of, and that tells you something. When you fall in love with an investment, that's a bad sign, right? You should never fall in love with an investment. That's way to lose money in your portfolio. You need to manage your money, be an investor, right? Do risk management, take profits when you can, and be willing to go back in. If it goes back up, sure, I'll go back in, right? But when you reach certain points where the room for movement up is kind of limited, as I've shown you, I mean, manage your portfolio, right? And so like what gold has been doing, and this is the last chart I'll show, but there's this pretty, this trend line's been going on since late last year, and we're hugging it right now, right? So let's see what happens. I mean, we go up, I'm going to buy more, right? Buy more. But if it goes down, I'm just going to wait and buy more cheap. That's the whole point. And I live in a country in Singapore where there's no tax in gold, and I have a good dealer who's just down the street. And I can easily buy and sell gold, and the overhead's actually not that high for me because of the relationship I have with the dealer. So moving along now, has retail finally given it to the hedge fund gurus? And this is an interesting chart because, and this is from Goldman Sachs, basically the way to read this chart is when the ratio rises, right, which it currently has been doing, the retail index is beating the guru index and the hedge funds. And so lately, ever since the bottom, it's true. The retail are winning, right? And they had been winning since 2022. So technically speaking, in this time frame, retail crowd, the dip buyers, some of them the gamblers, are winning. There's no doubt about it, right? The data is showing that. So I'll be the first one to admit it. And this information over here clearly tells you that that's what's going on. But are they going to win? Well, the casino never loses, guys. They might let you win here and there, okay? But the casino never loses. It has never lost in the history of its existence. And whenever you feel like you're beating the casino, you should be worried, okay? And that's basically what's going on. Because if you see what's going on, right, outside of the day-to-day trading, is a big credit event waiting to happen, right? Don't forget Japan. Look at this. This is from 07 to now. This huge rise in Japan's yield, and not just their super long-term 40-year, right, or 30-year. We're talking their 10-year is going up to 1.6%. This is what they used to refinance. Now, I know they print money and it's their own debt, it's not foreign debt. But still, this is what losing control, right, looks like. When it just starts shooting up and they can't control it, even with the pressures, that their ability to just buy the debt, right, and do yield curve control is gonzo, because things have changed. And this is a credit event waiting to happen. And that is the type of thing that will, just obliterate the dip buyers and all the retail buyers, because it's just going to go straight down really quick, really fast, and scare the bejesus out of everybody. And that's what credit events will do. And if you think about it, this weekend is voting time in Japan, right? And our friend over here, Prime Minister Ishiba, is facing a serious issue. He may lose majority vote of the lower house, which is the most powerful part of the Japanese government. And if he loses it by a lot, he may actually be forced out, right? Even though it's very risky, given Japan's in the middle of negotiations with the United States on the tariff deals. If it's really bad, he might get forced out. And that would be very destabilizing for the economy. Japan is suffering from inflation. The price of rice in Japan, which is, the staple food there, has just shot through the roof, doubling and even more. And it's become a huge political issue, right? And that is the inflation along with the debt, and now this tariff. Japan has been eating and lowering the cost of particularly the automobiles it's been exporting to the United States. And that is really starting to hurt the economy. Now, Japan could very well go into a recession because of all this trade wars there. But on top of that, they're losing control of their long end yields, right? And that's really dangerous, not for just Japan, but for everybody. Because what's going on is when Japan's yield goes up, so does the yield for all the developed nations around the world, including the United States. Now, this spike was when Trump tried to do a float test of firing Powell, which this happened, and he quickly pretended like he never said it, although he clearly did in that Republican lawmaker meeting behind closed doors, where he was waving around the draft that Pult was drafted for him, the head of the, basically the housing board of the government. And, the U.S. Treasury, 30-year Treasury keeps rising, right? And this dotted line is the Fed. Now the Fed was raising rates in 2023 and into 2024, and that made it raise. So when they stopped rising, so when they started cutting rates late last year, everybody thought that, well, rates will come down, and a lot of people bought houses, with, even though the mortgage rate was high and the price was high, because they believed that the Fed was cutting rates, so this was going to continue down, and they could refinance with lower mortgage rates because the mortgage rates track the long end of the yield curve, and they would refinance their houses, which they bought at expensive prices, down low. But that has not happened. In fact, the exact opposite has happened. The Fed cut rates, yields went up, which is terrible, right? And if the Fed cuts rates this year, which everybody's trying to get them to do, including Donald J. Trump, yields will continue to go up. Mortgage rates are going to go up. This is very, very bad, right? Which is one of the reasons they don't want to cut rates, because they know that if they cut rates, it's going to stoke the inflation flames, and people are not going to buy the long end of the yield. So that means they're going to have to increase the interest rates to entice people to buy it. And that's a problem they've been having. And that's why yield was going up, because we're nearing the end game of the debt problem. And we're talking sovereign debt of the United States. Now, it's not just the United States, it's all developed countries. Now, the US is in blue, but what we have in white is Germany, right? And the German bonds are also skyrocketing up, right? This is not good, right? It's leading the United States. And so this is a global problem. Part of the problem is, this is why I do think the dollar is going to continue to go up, which I've talked about in my previous, but basically what's going on is you've got a situation in Japan, right? And Japan, remember, is the distribution center for the US dollar through its carry trades, because for the longest time people took advantage of the low Japanese interest rates, they've been the one doing quantitative easing and yield curve control forever. They're the pioneers of that. And because it was so low, people taking advantage of the discrepancy in arbitrage in interest rates between their country and Japan's super low rates, and doing the whole yen carry trade. And that enabled basically Japan to become the distribution center of the global reserve currency to do the carry trade on, which is the United States dollar. And if Japan has another credit event or some kind of a heart attack, right, because the long end are just skyrocketing, they have this upcoming election on Sunday that is very problematic and politically charged because of the inflation, particularly around rice. There's a lot of angry Japanese. Nationalism has kind of not really hit Japan as much as it has the US and Europe, but it could hit now when we're seeing the minority party way on the right coming in. And so all these factors are swirling into this election that's happening on Sunday, and you better look out, right? Because if something goes amiss here and something goes wrong, and remember, Besant is there. Besant just happens to be in Japan during the elections talking to, and Ishiba made time to actually sit down and talk with him. Something is very, very precariously on the edge right now. And I know, people aren't talking about this as much. They're talking about all the other stuff going on with Trump and the Epstein files and all the other trading. Don't forget about Japan, right? We had the scare last August when there was a little bit of a year carry trade unwind scare. And remember, the markets tanked like crazy, right? And the VIX hit like super high. Because of that scare, it was a precipitous, quick drop and shock, right? And you got to be careful that this is not coming our way, given what's going on with Japan, and given that Japan is the distribution center through its yen carry trade structural dynamics, that this might not happen. So we got to be very careful about what's going on in Japan. Don't forget about Japan. That's my mantra right here. If there's one thing that's going to kill the retail traders and the dip traders in a flash in the pan, it's a shock credit event type of thing that can torpedo the entire gains that we've had in just like 1 week even, right? Now, going back to whether or not retail has finally stuck it to the sharks, a lot of people like to use the leading PE ratio, right? To say that the stock market's really expensive, but I think that's a little bit not good, because the fact that it's a leading PE ratio is like you're factoring in what you think it's going to do in the future, and that's all speculation. So what I'd rather look at is the trailing PE ratio, which this chart shows you. It's a very different picture. And this is accurate because it's trailing. It's actually locked in data that we're looking at in terms of how expensive the S&P 500 is. And if you look at the trailing PE ratio over here, you'll see that we're about to hit 30. So the message is actually similar and the same. It's like it is expensive, because whenever we hit 30 in the past, whenever we hit this, we've had recessions, right? Even this blip here was 2020. We had that 2020 blip. And we're creeping up here, and we're about to hit 30. It is very expensive. There will be probably a recession, even though nobody's talking about it. And remember the whole inverted yield curve, and now everybody says that thing doesn't apply anymore. Whenever people start saying like they figured gravity out, look out, because we're not God. We have not figured gravity out. And we did not figure out some new form of economics. That's just not true, right? The thing that everything is pinned on is human greed and fear. At the end of the day, that's the core of what everything is layered on top of, and that has not changed and will not change, because that is just human nature, right? Until we get to Star Trek level, or we have a replicator that builds everything, that's still the case. And so no matter how you feel like we have a new monetary theory and some new paradigm, is we figured out we'll never have a recession again, it's only going to be up and never going to be down. When you start hearing things like that, we're closer to the end, right? Because no, we haven't created a new paradigm, and we're not God. We did not figure gravity out. So even in the trailing, which I think is a much better indicator than the leading S&P 500 PE ratio, is showing us that it's very expensive. That to me is a confirmation to look out, right? Now, retail traders are off the look. This has been going around, the social media, but it's absolutely mind blowing. We're 66%, almost 2/3 of all the volume every day in the market trades, right, is on 0 DTE. 0 DTE meaning 0 days to expiration, meaning like the options that you buy expires by the date, which means that you're doing day trading, in other words, right? You're in and out within that day because it expires in that day. And so that means all these retail traders are basically day trading, right? And what enough of that is happening where we're basically almost 2/3 of the entire day's volume is day traders, which has never been nowhere near that ever in history, right? This is crazy if you think about it. Look how little it used to be in 2011, right? We are now, I can't tell you how crazy this is, right? So this is telling you that all the volume is around day trading bets going on. And when a huge credit event, right, a shock happens, that means that the drop is going to be that much more violent than it was before, because of the configuration of the internal dynamics of the market today, which is all majority on 0 DTE options. And you know who's doing those, right? It's us, the retail traders. Now, what does that look like in a picture? It looks like this. And what are the retail traders buying? They're buying this, right? The rest of the market is really unhealthy. It's a sea of red, right? What's going on is there's just a few stocks that all the retail traders are buying, basically betting on, that's keeping the market up. And this is the best picture I can show you to tell you how unhealthy this is. Unhealthy. You do not want just a few and the rest doing terribly. This is a very unhealthy market, right? And just to show you how unhealthy it is, in 100 years, we are the most concentrated we've ever been, right? The market cap of the largest stock relative to the 75th percentile stock, right? We know what this means, right? Is at the highest it's ever been. Highest it's ever been, right? Higher than the Great Depression, right? Way higher than the dot-com bubble, right? Way higher than when we had COVID. Way, way higher than when we had the 07, 08 financial crisis, right? And all the other collapses we've had. The fact that we're higher than 1928, 29, right? The Great Depression, this really scares me. This was when everybody thought they were going to become millionaires. The shoe shine boy that you get, you would pay the coins to shine your shoe was giving you stock tips on what to buy. I mean, everybody was talking stocks. Everybody, I mean, when the shoe shine boy back in 1929, that tells you something, right? Everybody was speculating in the stock market back then and was super concentrated on just a few. And we're more concentrated now than before, right? And everybody's doing options trading. I mean, this is a very, very, very dangerous situation. If you look at it here, the ratio of the market value of the 5 biggest stocks to all small stocks combined, again, at some crazy unheard of levels, right? We're almost 5 times that, the 5 biggest stocks compared to all the small stocks combined. 5 times, right? Here's another one. Nvidia's market cap to the entire United States GDP is 15%. It's getting to 15% by. This is a little outdated, right? 15% of the entire United States gross domestic product is the market cap of Nvidia. That is just a crazy, crazy statistic, right? That is unheard of, but then it gets better. It gets better. Nvidia is larger, right? And now this is 4 trillion now, so this is outdated, than all of UK. Right? This is crazy. All of France. I mean, this is crazy. And now that we've hit 4, I mean, it is a crazy situation. So, like I said, so going back to, did retail really beat the sharks? And bear in mind, the hedge funds are still max short, right? Especially with the small stocks. In fact, the Russell 2000, the small stocks, the hedge funds have added on. They've tripled down and are the most short ever. Right? As far as data I saw from last Friday, I don't have the chart up, but just take my word for it or Google it. So hedge funds have tripled down into more short positions as retail continues to buy as it goes up, right? And the thing to note here is retail has definitely increased its market share and activity. They're piling in, right? By the hundreds. It's like the gold rush. And that much is true. And as I showed you in the chart earlier, the market has gone up. But here's the thing, the way it has gone up is super unhealthy. It is super concentrated to just a few stocks that are now worth more than entire countries. And whenever that has happened in the past, it has always led to spectacular collapses, right? All the time it has led. It is a very unhealthy thing because what it tells you is that the boat is so lopsided, right? Like literally everybody and then more came in, right? New people jumped on who weren't on the boat, jumped onto the boat, right? The people on the boat already was like super lopsided. Everybody's just like on one side, not even just one side, just in a few stocks. And then on top of that, all these people who weren't on the boat came onto the boat and jumped onto that same spot. That means the boat is like so concentrated and so turned and tuned into this position that when there's going to be some event, perhaps Japan, right, because of the reasons I told you, that causes that imbalance to reset, it's going to be such a violent upturning and turnover and that's why in history, whenever you're this concentrated, bad things happen, right? And I guarantee you something bad is going to happen because of the configuration that we're in right now. There's no way that this is not going to lead to a very bad situation. Now, I'm not a fortune teller again. I can't tell you exactly when and what that trigger is going to be. But you don't need to know that, right? You just need to know that everybody's on the boat on one side. That's it, dude. You're just going to take one look at that and be like, bro, this is a very precarious situation. And so having said that, right, let's take a look at, one of the things that happened this week was the CPI numbers came down, and it was a little under expectations, right? And and there are a lot of people saying, look, the tariffs don't matter, the tariffs don't matter, but you got to understand, right? Remember, the GDP print was negative, and a lot of people are saying the only reason why it's negative, they're proven wrong though, because discretionary consumer spending collapsed. That's why it got revised lower. But the reason why GDP printed lower, people were saying, was it was a one-off. And the reason why was because of the tariffs. A lot of companies front-loaded, right, and pulled in future demand to stockpile so that they were prepared for the tariff situation before it struck. And so they did it so much that the GDP came in negative, right? So that gives you an idea, an indication of how much they pulled in to actually say that, or calculate that the GDP came in negative. That inventory has acted like a buffer, right? No, if you look at the supply chain, it takes months, right, for it to travel from China. Like, so after the tariffs, the ships that were already weren't impacted, so it's the ships that left after the tariffs, and it takes them, many weeks to get there, and then once it gets to the ports, it got another many weeks to then distribute. So that in of itself is already like a month and a half to 2 months, right, to really percolate and distribute. Then on top of that, you add all the buffer that these companies have bought. So the lag effect of the tariff to inflation and increased prices has been extended, right? And people forget about that. They think that it should happen instantly, and that they forget about the front loading that all the companies did. And they front loaded a lot. So make no mistake, and this is what some of the Fed officials are saying, like Bostock and them are saying, we can even see it next year, right? It could take up to the next year till we'll see the impacts of it. And that could happen, right? They front loaded so much. Now they're chewing through the buffer is going down. So yeah, I do expect that to come out, and you're seeing it already in the PMI, the producer manufacturing index. The input and output prices are going up, right? They're going up. They have been going up, right? And the output prices of the PMI is a leading indicator of the CPI, right? PMI output is a leading indicator of CPI. And here, Goldman, the folks over there did a little thing where they pulled it forward, or in the S&P, where you can see now, right, it has gone up, and it's probably going to cause the CPI to go up. So, just be patient, right? It's coming, right? There's fundamental reasons why it's lagging, and then there's some, forward-looking data that's telling you of what's to come. And if you think about it those terms, there's absolutely no denying that we haven't still seen the full impact of the tariffs. And the tariff deadline that Trump pushed out to in the beginning of August is coming up. And the fact that, like I said in the last episode, there's, Trump can't operate when nobody believes in it anymore because of the whole taco situation. That just can't happen. So he's going to have to stick to his guns, right, come August. He can't continue to just keep delaying everything, because all the other countries are just going to gang up on him and just call his bluff, right, and just wait for him to taco out. And that's just not going to be a sustainable way for him to run policy, especially financial policy, for the country. I mean, he's got all these other headaches that he's got to deal with now. So he's going to have to basically undo the taco effect. He's got no choice, right? He's got to be the POTUS, and the President of the United States can't operate when nobody believes the President of the United States. So that's coming up as well. So we've got multiple things going on. The Japan debt situation could trigger a credit event. We've got the tariff thing coming up to a head, and we've got retail just completely piled in. And so, like I said, let's just see what happens in the coming week or two. Now, I'm already positioned, and I'm not, changing any of my positions. I'm fully set up right now. I'm just waiting to see what happens here. And if you're careful, and if you're smart in managing risk, you'd probably be doing something similar to your own portfolio in the way that matters for you and your own risk managing profile. So having said that, thanks for watching. I'll see you in the next episode, and let's see what the market brings at that point in time. Peace.